welcome everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, March 2nd, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Let's see, currently we have futures mixed. Dow futures up 66, S&P futures down 16, NASDAQ futures down 76. So on a percentage basis, obviously, money rotating a little bit more toward the Dow and away from the NASDAQ. Crude oil prices up 32 cents per barrel to just over $78 a barrel. U.S. 10-year Treasury yield up almost 5 basis points today, 4.04%. So we're getting that potentially that first close above 4% today, at least the first close in a while. Yesterday we closed at 3.99% after touching the 4% level. But clearly the higher interest rates having an impact on the market. I've been talking about maybe expecting to see the Dow, maybe the financials, industrials, energy, materials, those areas maybe leading again. They led into the end of the year. They took January off. That's when we saw the aggressive groups like technology, discretionary, communication services. All of those groups soared during the month of January. February was a little bit of a mixture, but the growth areas, I think, still kept their lead. But now with the rates moving back up again, it just feels like money is going to rotate. And it seems to be starting based on the action yesterday and what we're seeing so far in pre-market today. But we'll talk about that in just a minute. First, let me go through the agenda for today. So we're going to start off with the daily market recap, as we always do. Then talking technically, sector outlook, earnings spotlight, and we'll wrap up with the 3 you must see. Let me, before we get everything going, I'll take you over to Earnings Beats. For those of you who are new to the show, welcome. Always love to have new folks joining in. For those of you who have been with me for a while, welcome back. Certainly appreciate your support and loyalty. And I know there are a lot of you out there who don't agree with me about the market sometimes, and that's fine. That's what the market is. It's made up of 2 sides. Pick your side. But for those who are new, if you go over to earningsbeats.com, you can scroll down. We do have a Earnings Beats Digest newsletter. It's a completely free newsletter, no credit card required. You can unsubscribe at any time. I publish it 3 times a week, Mondays, Wednesdays, and Fridays. All it takes is a name and an email address. That's it. Hit that subscribe button. We'll get you set up. Love to have you there. If you want to try our service, we do have a 30-day free trial for our full paid service, but you will have to provide a credit card on this one. Good news, though, before we will charge you anything at the end of your trial period, we will reach out to you, make sure that you're comfortable with the service, and let you know that you're going to be charged. So we're not going to just all of a sudden try to hit you with a hidden fee or something that we're not making you aware of. So if you want to try us out at Earnings Beats, I think you'll like the service. Lots of guidance, market guidance, research, education, things I think that will help in your trading and in your investing as you go forward. Again, you can start your trial right there using that no-cost trial button. Love to have you. So let's move on. What happened on Wednesday? Well, the Dow Jones Industrial Average, you can see, finished up 5 points. Woo, big move. S&P 500 down 18, NASDAQ down 76. So you could see that bifurcation already beginning to start yesterday as we opened up March. And I've been talking about March historical tendencies, and this is kind of normal for March. We tend to see more value-oriented and defensive-oriented stocks do a little bit better during the month of March. We're now past earnings season. We've gotten past the Q4 earnings that came out in January and February. Still a little bit too early to be thinking about Q1 earnings that'll start coming out in mid-April. And so we're just kind of in this quiet period for the market, and that's when we tend to see money rotate back out of aggressive areas and into defensive areas. So I've mentioned I think the market is most vulnerable right now, potentially to the downside. Short term, now I'm talking about throughout the month of March. If we're going to go down, I really think it's going to happen this month. I think we started it already in February. Second half of February historically is much worse than the first half of February. We saw that play out again. I mean, you can just look at the chart. Look at the second half. Look at the Dow. Look at the S&P. Look at the NASDAQ. I mean, I don't make this stuff up. This is historical tendencies. It's not a guarantee, but I'm not surprised when history follows its historical pattern. And that's what we saw at the end of February. March isn't a bad month. It's just a month where we tend to see more defense and more value-oriented stocks perform better. So I wouldn't be surprised to see us, maybe lose a little steam in the major indices, because most of those stocks are not stocks that are heavily weighted in the major indices. The stocks that are heavily weighted mostly are aggressive stocks. You've got Apple, you've got Microsoft, you've got Tesla, you've got a lot of various software stocks and semiconductor stocks, NVIDIA. Those are the types of stocks that are heavily weighted. So if they fall out of favor in the short term, even if it's only for a few weeks, that's when you could see a little bit more pain inflicted in terms of the major indices. So I think March is going to be one of those periods where we're probably going to have to deal with rotation, and it may not be favorable rotation for the market. Mid caps, small caps, you can see both up close to about 1/4% there. Leadership, and I think probably want to get used to this. I think energy, which is down close to a support level. I wouldn't be surprised to see energy do well in March. Materials already has started to move up. Volume's been picking up, looking pretty good there. To the downside, utilities actually usually have good marches. This is probably the best month. Actually, I think this is utilities' best month relative to the S&P 500 historically. Didn't get off to a great start yesterday, but I wouldn't be surprised to see it maybe make a little bit of a comeback at some point during March. Real estate down 1.5%, another defensive group, and then discretionary down 1.25%. Watch the 50-day moving average there on discretionary. If we can't hold that, we still got a couple dollars, $2, $3 down to the 50-day. If we can't hold that, I think that's when we're setting up maybe to this other low back here in mid-January, which could be back in the mid-130s. That wouldn't be a shocker to me in March if we do pull back. I've said I think the S&P 500 potentially could go down and test this 3775 to 3800 area. Said that when we were up in the 4,000s. I mean, I feel like this is the period of time, if we're going to pull back, if we're going to make it appear as though we've got another big leg down, this is potentially when it could start. So keep all that in mind. Let's move on to the 10-year Treasury yield. So yesterday we did close at 3.99%. You can see still easily holding on to this 390 area, which is now support. That was resistance. So we had a double bottom with the 390 resistance in between. So I think of consolidation until we clear 390. Well, we have cleared 390. We're not looking back. We closed at 399 yesterday. We're over 4 this morning, up 5 basis points, like I said at last check. So up at 4.04%. Are we going to get the 433, the high back in October? I don't know. Possibly. We don't have a Fed meeting for a while. It could be that we just start making our move up toward that Fed meeting. Still got a few weeks to go, I think, before we get to that. But anyway, that's what I would be looking for there. I'm not, now that we've broken out above 390, I do think the path of least resistance is to the upside. Watch the 20-day moving average to the downside. You'll have support at 390. Also, that rising 20-day tends to hold its support during uptrends, as you could see during this uptrend. First time we came down, hit that 20, bounced right off of it. So if you look at the other uptrend back here, basically any pullbacks held that 20-day. So if this truly is another uptrend, I think you're going to see that rotation I talked about, which will be a little bit more defensive and value oriented. And I would be watching the rising 20-day. As long as it stays in this move to the upside, those areas of the market may be your outperformers. I do expect that we're going to see the yield roll back down, but it may be April before we see it. Maybe later than that. We'll keep watching it. One thing I wanted to mention with the yields, though, if you notice the last time we had to push, actually the last 2 big moves to the upside, there's 1, there's 2. The spider mostly outperformed the QQQ. So the S&P 500 was mostly outperforming the more aggressive NASDAQ 100 when rates were rising. Same thing almost to a T here. Right when we bottomed, that's when the ratio bottomed, started moving up. This was kind of weird, November and December. Even though rates were coming down, we saw money still mostly sticking with value and defensive-oriented stocks, which is normal, by the way, for November and December. That's what we tend to see. But that didn't really correlate very well with the pullback in the 10-year Treasury yield. But then as we pulled back in January to start the year, you did see the spider underperform the QQQ. And now that we're turning back up again, we're just right now going sideways, but I wouldn't be surprised to see this start to move back up again. XLY, XLP, actually, this is the XLP versus the XLY, so it's different. I usually show it the other way. But look when rates were going up, and look at the XLP versus the XLY. Rates came down. This ratio came down. Rates went back up. This ratio went up. Excuse me. Hold on one second. Thank you. All right. And so when rates went up, we saw consumer staples outperform discretionary. When we had the drop in January, big drop, money completely rotated out of staples back into discretionary. Now we got yields going back up, and you can see, again, we're starting to turn back to the upside. This is kind of normal behavior. If rates are going up, that's normally not a good thing for growth stocks. But if, money is going to rotate, we're likely to see it rotate toward areas that will benefit more during periods of rising rates. All right, S&P 500. So another down day yesterday. We did close at a fresh, I don't know, maybe 1 month, maybe about a 5-week low, something like that, maybe 6 weeks. So the S&P 500 definitely rolling over since the first half of February. Still got higher highs, higher low, higher high, higher low. So at least the low the uptrend off of that October low still intact. That would only fail if we go back down below about 37.75 or so. So that's 175 points from here. That's a little bit more than 4%. NASDAQ 100. So looking at this chart, of course, we did much better here. But we too closed back down probably at about a 1-month low, threatening the end of January. That low right there. Let's see what that was. So the low low close on January 30th was 11,912. Yesterday we closed at 11,938 with futures this morning, likely to take that out on the opening bell, unless we get some kind of reversal into 930 this morning, which that's possible. But at least what we're seeing right now would suggest that we're probably going to open beneath all of this. I'd watch the 50-day, which is down at 11,738. And then probably the only real pullback that we saw with some selling took place in mid-January, and we got back down to about 11,300. And so where we are right now, that'll be 600. That'd be about a 5% move. So if the S&P were to fall back 4%, I certainly wouldn't be surprised to see the NASDAQ 100 fall back 5 or 6%. So that could be the level we're looking at. Let's see if the moving averages hold. Moving on to the industry outlook, actually sector outlook. Wanted to just go through these charts. So we got an uptrend here on the XLK. This is technology. This is the more aggressive group. The last high, we did see a slight negative divergence, which generally means look for a PPO centerline test, look for a 50-day SMA test. We're getting close to both. Do we hold? That's going to be a question that'll give us a pretty good clue as to whether or not the S&P and the NASDAQ continue moving lower. Both the S&P and the NASDAQ is very heavily influenced by the stocks that make up the XLK. So this is the biggest sector to be watching. We're below the 20-day. We've struggled to get back up above it. We certainly appear to be trending back toward the 50-day. I would expect a 50-day test at some point. And what we do from there, I think, will give us a pretty good clue as to what's going on in the market. XLY, this is consumer discretionary. Very similar. You got gap support almost right where the 50-day moving average is. Gap support comes in at 141.71, and the 50-day is at 140.95. So literally within, a dollar of one another is where 80 cents, whatever. That's where you're going to find some pretty good support for the XLY. We'll see if that holds. XLC. So communication services, what a huge run from the end of December through the beginning of February. Best performing sector by far. I mean, we're talking 46 and changed, almost 60. That's over 20% in about 5 or 6 weeks. That was a huge move. By far the best move we've seen in communication services for over, I don't know, the last 15, 18 months, maybe going back further than that, probably sometime in 2021. But we saw a lot of profit taking during the month of February. This group was straight down, still not showing any signs of recovery. We're all the way back down PPO center line, very close to the 50-day. And if I annotate this one, just want to show you, see a lot of there's a bottom right over here in June. And then you got a bunch of tops coming across here in October, December, twice in December. And then another small top here in January, pulled back before we finally broke through. So 4 or 5 different times you can see we struggled right at about this 52 to 52.5 area. Well, on the way down, broken resistance becomes support. So that's an area to watch. If we fall much below 52, certainly below this low over here, I'm going to say at 51, that is going to start painting a much more bearish picture for communication services. But these are the first 2 lines I would watch. AD line, even with all the action to the downside, AD lines remain strong. So it tells me there's probably still some significant accumulation taking place and makes me think we're going to turn back higher. So I'm still in the camp that any pullback that we have here is going to be temporary. I do expect we're going to have a big rally going into Q1 earnings. So later in March, early April, I think that's when we're going to get our next big move to the upside. Let's see, next sector. Look at XLF. Still looks good. Higher highs, higher lows. We've pulled back. We're at the 50. I actually think we're going to probably see more rotation heading into financials here, especially with rates going up. Normally, that is a good thing for financials, industrials. Both of those tend to do better when rates are going up. That means the Dow usually does better. The S&P normally outperforms the NASDAQ and so forth. But there's your XLF. But it's already hit the 50-day. It bounced off the 50 in January. I'm kind of looking for it to move higher from here. To be more defensive, I said this on my show yesterday, moving away from the NASDAQ and into the Dow or even the S&P, but the Dow probably more so in the short term, I really wouldn't argue with that. Given history, given the way everything looks in the market right now, given the fact that rates are moving higher, probably wouldn't be a bad thing. And if you are in, something more aggressive like the NASDAQ and you want to be more conservative, maybe you don't move everything, but maybe you move a portion over into the spider, maybe a portion into the diamonds. Just kind of, I don't know, cushion the fall if the market goes down. That might help to cushion it a little bit short term. Industrials, big move up, mostly sideways consolidation. We went just below the 50-day, bounced back up above it, starting to show a little bit of strength. AD line looks strong. I expect industrials, I think they're going to have a decent March. I wouldn't be surprised if the rotation occurs like I think. I wouldn't be surprised to go back up and challenge the high in February. 104, be another 2 or 3% to the upside. XLV. So let's move on to defensive groups, healthcare. This group has not been in favor for a while, and it's really been falling pretty hard. Volume trends not good. A lot of hollow candles, though, if you look through here. Even yesterday, we were down, but we finished above the open. So we're seeing gap downs, but not necessarily a lot of selling. intraday. And that's why you're seeing the AD line hold up pretty well. I mean, the AD line's higher than it was back at the beginning of December. The XLV's dropped from 141 down to 127, down 10%, and the AD line's gone up. Anyway, I wouldn't be surprised to see a bounce back, just even to the moving averages in March. That would kind of make sense to me. XLP, so consumer staples. Talked a little bit about this earlier. A little bit of a hammer, but not really at support. It's below support. Here's another support area over here around 70. So there might be a little bit of downside, but like the healthcare group, look at the AD line moving up, even though price action's been coming down. It means that you got a lot of tails in here to the downside, a lot of intraday selling, and then buying back during the day. That's what creates higher AD lines. Anyway, again, like the XLV, I don't know that I'm looking for these stocks or these areas to take off, but on a relative basis, they may do okay. And on an absolute basis, moving back to the moving averages wouldn't be a shocker here. Just oversold. Some of these, healthcare staples, I think, are oversold. Utilities, another one, I think, oversold. And knowing March is the best month of the year historically, might be a good opportunity to take advantage of some of the selling in the near term. XLRE, real estate, moved down there. Again, we've seen it with all the defensive groups. Could we simply get a bounce back up to the moving averages? Maybe more. Yeah, I think it's possible. And then the XLE and the XLB. XLE has come down pretty close to the support area. I had previously talked about equal highs and rising lows, and then it broke down. But I said that isn't necessarily bearish, just means that the ascending triangle is no longer in play. Rectangular consolidation, a rectangle pattern after an uptrend. It's kind of like a flag, pennant, whatever you want to call it. So it's still fine. As long as energy stays above 81.75, I'm good with it. And so if money's rotating and we're looking at value, a lot of these energy stocks pay pretty nice dividends, and I could absolutely see money rotating back in here. It may have started yesterday. So watch energy, watch crude oil prices, which are back up above $78 a barrel. If crude oil gets back up above 80, I could easily see energy making a run back up toward the highs. XLB, last one. Higher highs, higher lows, and clearly starting to move back up. Look at the volume coming in. And there are a couple areas that I really like in the material space. Steel, I think steel still looks really good. Aluminum, after a pause for a while, starting to strengthen again. We've been seeing this now since the end of September. It's back up above the moving averages. I could easily see a challenge up near 200, and that's going to be a big level. If you get up above 200, you'll be breaking out of a bottoming head and shoulder pattern. Left shoulder, neckline, head, right side of the neckline, right shoulder. Watch aluminum here. Potentially could be making a move up. All right, let's move on and talk a little bit about earnings. So the earnings spotlight. Can't go through an earnings spotlight without talking about Salesforce.com. Big report last night. Huge response back to the upside. Look at the AD line, which has been soaring. Even though you can see lower highs, and all of a sudden, since about December, look, tell me if you see any big red-filled candles in here, because I don't. I see some hollow candles, lots of hollow candles. That means you're closing above the open. Even down days, we saw some hollow red candles in here. 4 or 5 of them in the last month. That means you go down for the day from the prior day's close, but it means you close above the open. So it's manipulation. Stock's getting hit at the open, and then it's being bought during the day. Talked about this for months and months and months. CRM's poster child, Salesforce.com. And this morning, it's trading. Let's get you the latest here. Up $26, 15.6% today. Easily going to clear recent highs in February. This is a big breakout on CRM, and it's going to be one of the reasons why the Dow gets a lift today. CRM is one of 30 components in the Dow. Some others. Now, when I was looking at some of these software stocks, I really thought the best one would be Splunk. And Splunk had a great report. I mean, blew away estimates. But sometimes what you see in terms of reaction, or see in terms of the actual report, and what you see in market reaction can be completely different. And this is what makes holding into earnings so treacherous. Because I can feel very comfortable saying, you know what, I think the way this stock is trading, it's going to come out with a good report. What I can't tell you, and what I don't feel so comfortable about saying, is that this stock looks really good heading into earnings. I think it's going to gap up. That is hard. That's a harder call. And so let me just show you a couple of these. So this is Snowflake. Snowflake beat, by the way, top and bottom line easily. Stock down 8%. Then let's take a look at Viva Systems, another software stock. This one, they beat, but they didn't beat by nearly as much on a percentage basis as Snow, and not even close to what Splunk did. Viva, on their bottom line, came in at 115 versus 104. Stock's up 6%, which, I mean, had a good report. Don't get me wrong, that was a good report. And it's been an underperformer. This was one I questioned whether they would come out and beat. But they did. Came out and beat. Stock's up. Okta, another one I questioned, just had not been a very good performer long term. 14% up, $10. Looks like maybe we're going to get a breakout at the open on Okta. They had a nice beat, 30 cents versus 10 cents. Revenue, 510 million versus 489 million. And then Splunk. Now, before I pull this one up, their revenues were 1.25 billion, expected 1.07 billion. They beat their estimate by $180 million. Their earnings were expected to come in at $1.11. They came in at $2.04. This is a stock that's been outperforming big time in the software space relative to some of the other software. And this is how they got treated, down 4%. Now, big move up. I think probably this is an opportunity. I think the gap down, I don't know if we're going to go up right from the gap down, but anything, as you get closer to that 50-day moving average, you can see we've been bouncing off of it. I think that would be an opportunity on Splunk. These were great numbers that came out that I see. All right. Anyway, I got to get running because I'm running out of time here. Got about another minute left. So let's move on. I want to just go over to wrap up with the three you must see. Let's just take a look at the Dow components here. And stocks that led yesterday. So we already looked at CRM, but let's look at CAT, 3M, and Amgen, the other three top performers from yesterday. So there's CAT breaking back up above moving averages. I think this one could get started again. I think this could be the start of another move here. 3M, not looking so good. Maybe a slight positive divergence, but I think we still might test that 105 level. And Amgen, nice bullish engulfing candle here. I think we at least get to the 50 or to the 20, but I really think with that positive divergence and that reversing candle, we're heading back to the 50-day here. So I like Amgen. All right, that's it for me. I do want to mention I am on vacation starting tomorrow through next week. I will not be around to do the shows. I just wish everybody a great weekend, great next week. I'll be back the following week. We'll have evergreen shows replayed here on StockCharts TV next week. Over at Earnings Beats, I will not be doing my shows on Monday and Wednesday until the following week. Everybody have a great weekend. Enjoy your next week, and I'll see you when I get back. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.